Hello and welcome. You're watching KYC. I'm Hersh Sayta. With me is Puneet Javeri. And today we're going to be talking about a possible turnaround in an RK Forgings.
Yeah.
Puneet clearly skeptical by your face itself. So it's difficult to argue against that with my co-anchor today. But let me first start off with what I want to know about an RK Forgings. One, there was a one-time knock with regard to inventory, and that has impacted margins for FY25 Q4, but moreover full year as well. How will margins recover by FY28? Because what they are saying is that margins will recover to 24 to 25% by FY28. If it's just a 1 quarter problem, why is it going to take 3 years for the margins to recover fully? I don't know if you have an explanation for this, but I'm certainly keen to know this aspect. Do you have one?
No, my point is larger that the company is still maintaining that this year they might go to 19 to 20% as well. And given quarter one, that's still, and the uncertain export outlook that is there. And as you rightly said, because they've already said that they've solved the inventory issue.
Correct.
So definitely,
so why shouldn't it
why should it take 3 years? Yeah, definitely.
Okay, so we'll ask them that. Have the relevant system upgrades happened? Why was there the inventory problem? Inventories were, the price or the value of the inventory was overstated, and therefore we had to take a large cut. That is because of certain systemic issues. There was no cash outgo as a result of this. It was purely accounting which was the problem. And of course, therefore, because there was an overstated inventory, there was overstated profitability for past years. Not quantified as to which year, how much. But that's certainly a concern, because that means the books of accounts itself for the last 3 years and the metrics that we will read into are not entirely accurate. But for the purpose of the impact, we've taken FY25, and that's what the company has also done. Now, have those relevant system upgrades therefore happened to solve for this problem? It was supposed to happen by September of 2025. I'd be keen to know whether that has actually been carried out, or are we on course? Third piece is how comfortable are they on numbers at this point? What is the trend that they are seeing? Also, how comfortable that there is no fraud involved? That's the other piece I'd want to understand. Risk to the margin recovery, if at all any. As Puneet said, 19% odd margin expectation for FY26. Whether that is under a threat, or is there any risk of that happening? The demand trend, both with regard to the tariff as well as global geopolitics, both are key risks for an RK forging where demand is concerned. So therefore, I'd want to understand what that impact is, and they've guided for 15 to 20% growth for FY26. Can they do that for FY26 firstly? And whether how long can they do that for is really going to be my question. But I'll hand it over to Puneet to take us through what the company is all about and to explain the setup.
Well, definitely, it's been an integrated player over the last 3 to 4 decades, started and makes larger engineering, metal and forging companies. It started off as a player for railways and then has gradually integrated itself in the global auto segment, and has been one of the key players in the forging as well as the casting aspect of it. When you look at their first plants, they have a major plant in Jamshedpur in Kolkata, as well as in Kolkata, and they have been looking to modernize it, and they've successfully done that over the last few years. They've also having revenue streams from both domestic as well as the export outlook from both US as well as Europe. They also are now increasing their share in railways. They also have a joint venture with Titagarh, which is another listed player, as well as increasing their share of EVs because of the aluminum content. So that's something that you should know about the company. In terms of products, very quickly, they do operate in the commercial vehicle space and in the passenger vehicle space largely, and within that it has multiple segments. Within components as well, it offers all these components which are visible on your screens. Forging is one of the major positive aspects which leads to diversification into multiple new products. When you look at the business model of the company, they want to become a one-stop solution. Essentially, these are some of the other key products for designing, forging, machining, as well as assembly. And they've successfully been able to do that, especially over the last 10 years with increasing focus towards US as well as Europe. The other piece is they sell to key OEMs, and these are some of the major ones that they supply to. Of course, with the commercial vehicle space, they do work with someone like Tata Motors as well as Ashok Leyland, but also global giants in the Class 8 truck market as well. When you look at the diversification, auto, railways, oil and gas and other segments are some of the key ones, with auto being one of the key ones because of the size of the industry globally as well. And they've also, in the main competition is likely like Bharat Forge, Forging amongst the key players, and Bharat Forge is the biggest one, and that's largely because it's almost 2 times the size of RK Forging. They have been able to diversify into defense as well for someone like a Bharat Forge, and hence the kind of stability as well as the higher premium in terms of valuation, and we'll just get to that in the end of this segment. But that's largely about the company gaining global market share as well. Very quickly, I want to highlight some 4 key risks. So that could be the cyclical nature of the industry, as well as higher capex is something that's been bothering this industry for the last couple of years, and with the absence of earnings growth, it's more stark about the cyclical nature of the business. We've also seen intense competition across the players, as well as current problems like inventory overstatement, amongst others, something that Hersh highlighted on. That's one of the key aspects. But let's, that's all about RK Forging, and let's, get into the metrics as well.
Yeah, let's, and we'll speak with Naresh Jalan, of course, the managing director at RK Forgings shortly. But let's look at the metrics that we look for where RK Forgings is concerned. You want to be mindful, again, about all that we've said over the last 10 minutes, because there are certain one-offs and those one-offs aren't fully reflecting on the financials of the past years. FY25, yes, it does. So an offset has happened in FY25. We look at those 4 parameters: income statement, balance sheet, cash flow, return ratios. We look at shareholding, street credit, valuation, street coverage. Cover all of those 8. Puneet, let me get you to start with the income statement.
Well, definitely. And, we've seen over the last few years, it has been able to maintain strong, growth in terms of income statement. And, it's visible from roughly about 2,000 to 300 odd crores. They did see a consistent jump till FY25, and that's where the problem happened, because the growth was largely absent in FY25. On that, they had the inventory overstatement issue that led to margins to collapse in FY25 to 13.8%, a level that's not seen, that's the company has not seen since the pandemic time. So over the last 3 to 4 years, that has been consistent in 21 to 22% margin. That gave confidence to the street. But over the last year, we've also seen the profits fall by 50% compared to F5, the previous levels, and hence this is slightly concerning, and we'll get the management to talk a little bit more on that aspect. Apart from FY25, they've been consistently growing with addition of capacity, and that's been one of the major positive points for RK Forging. Only in the last year is when we saw the margins collapse for the company, and hence we've given this a neutral rating for now, based on the company's positive growth until FY24, and absence of growth in FY25, and this overstatement of issues. So given this a neutral only on that aspect, and we'll get some more positive commentary, if any, from the management on this aspect.
Also, profit of 415 crore, not the right metric to look at.
Yeah.
It's on the screen. So
yeah.
I want to quickly carve that out. That's not the right metric to look at, because there was a deferred tax provision which was made, due to which the tax loss, the tax expense was actually negative, which has led to an increase in the profit after tax. But that's just accounting. That's not really from a cash flow perspective. You want to be mindful of that. Let me quickly also pull out the balance sheet. Around 2,000 odd crore of debt is what it sits on. 10,000 crore in terms of market cap. The shareholders' equity is around 3,000 odd crore. So the debt to equity is around 0.6 times. And it does have a decent amount of cash sitting in the balance sheet as well. It has around 100 odd crore, maybe 200 odd crore of cash sitting on the balance sheet. So that looks decent as well. So broadly, that's how it stacks up where an RK Forgings is concerned. But cash flow, Puneet.
And here again, Harsh, because the last year in terms of cash flow from operations also, fell to just 33 crores. And they've been maintaining a good rate of 600 to 700 crores in terms of cash flow from operations, and hence we've seen the CAGR of just negative 8%, and that's largely because FY25 cash flow is similar to what they did in FY22, which was impacted due to the pandemic. So a recovery in cash flow from operations will be the company's number one agenda. Because of that, the net cash flow is also negative of about 157 crores in FY25, and largely, hence we've given this a thumbs down based on the recent performance of the company. Again, commentary remains very, very key for FY26 and how these 2 points shape up.
Let's remove cash flow from operations for FY25. Let's just look at FY24. Even when I'm looking at FY24, there's pressure on the cash flow from operations. That's coming in from a higher receivable number and a higher inventory number. which is reflecting on the cash flow statement. So cash flow from operations have been under pressure in any case. So even if I remove FY25 as a year of cleanup, a year of washout, even FY24 this problem has been there. So you want to see whether you want to live with this problem, and therefore we've also, that's the other reason why we've given this a thumbs down, and a very evident thumbs down where cash flow from operations is concerned. Let's look at return ratios, and you'll see that it's largely maintained double digit. FY21 is of course a completely washout year given COVID. FY22 it's done 15, 23 and 24 they've done 19%, which is impressive. FY25 again is a year which is kind of a washout, right? So you want to see where does the ROE number actually stand at the end of FY26, and can they build on that number? There's a fresh equity infusion also which has been done, 205 odd crore of equity infusion, which is going to be book value accretive. So again, all of those factors need to be tested and looked at holistically just for the viewer information. Shareholding pattern, Puneet.
Well, the company has done a key aspect which you just mentioned of infusing. So we saw 200 crore impact on the net worth because of the inventory issue. The promoter has come in and decided to put 200 crores, and not just at the current price, but it is actually at 2,100 rupees per share. So it's almost 2.5 to 3x from the company's current price. This will also lead to lower equity dilution, and this is the shareholding largely is a key positive, because the company has reinforced a key investor concern of net worth erosion. They've decided to pull that money in and ensure that the dilution is very limited. So hence we've given this a neutral rating largely because in this aspect the public shareholding has come down a little bit, but largely it's a positive from the management of infusing capital at a key point where they didn't need to. It was a error in business which they rectified, but the 2,100 rupee per share equity infusion is definitely a key positive.
Okay, let's look at the street cred thereafter. So you've got all of those holdings reflecting for you. It's down 36% year to date, but it's down 13% in the last 1 month as well. 6 months down 23%. Year to date, we did share at 36% negative, but the 5-year performance and even the 1-year performance is down 32%. But the 5-year performance has been outstanding. It's been over a 15-bagger over the last 5 years. So very strong returns to shareholders over the last 5 years. Therefore, we've given this a neutral. You want to take up both street valuations?
Valuations, and we've seen the street coverage largely being positive for the company, but valuations as well. At 25 times price to earning does give comfort to the investors. It's very close to the valuation metric that the OEMs trade at, and compared to someone like a Bharat Forge, the valuations do give comfort for the investors from this point on. So we've given this a neutral rating largely to get some perspective on growth, and that will help the company going forward as well.
Yeah, and 41 times Bharat Forge also does defense. So you want to keep that in mind, that defense stocks in any case are priced at a slightly higher valuation multiple. Let's look at street coverage. 4 buys, 1 hold, 1 sell. 18% is the return expectation. Surely a thumbs up, and a long-awaited thumbs up when it comes to RK Forgings. So that's the one thumbs up coming in. Let's stack it all up, and you can see it on your screen. Rating parameters, all of them stacked up. We've discussed all of them. You want to see where the numbers start to normalize in FY26. 4 out of 8 is what RK Forgings gets for the moment. Let's go across. Naresh Jalan waiting by, Managing Director at RK Forging. Thank you, sir, for waiting so patiently over the last couple of minutes. So I want to start off by asking you, with regard specifically to the FY25 issues that you have you plugged the loopholes completely? Are you super confident with regard to all the systems and processes that you have now put in place? And is there no concern with regard to working capital from your side at this point, given the Q1 FY26 numbers?
I think we are super confident in terms of plugging all the issues which had been there in FY25, and I think we have done utmost in terms of our process and other MISs in place to ensure that no future reoccurrence of these issues happen ever in future. So I think we are extremely confident that the issue has been taken care, and it is now on a gone days.
Mr. Jalan, a very good morning to you, and thanks so much for joining in. It's Puneet this side. With that context, what is the kind of growth in terms of volumes that you are aspiring for FY26?
So FY26, we are looking at second half of the year to be extremely robust with the kind of capacity addition which we have had. And I think almost all our projects which were doing WIP, most of these projects are going to be up and running by end of September or first mid of October. So we are looking at very high utilization in the second half of the year. And we are looking at almost 15 to 20% volume growth in the second half of the year.
So 15 to 20% volume growth, largely growth driven by the second half. Do you see that happening for both the domestic market as well as from the export market? And if you can give some color both on Europe as well as US in terms of exports, because we've seen the tariff impact coming in US. So do you expect that Europe will be driving the growth at least for this year?
I think going forward, not for alone for this year, I think going forward for the next couple of years, Europe will be one of the major destination for us in terms of our growth in terms of exports. While US or the North American operations will remain quite steady and quite encouraging for us. I think with tariff and other things which are there in place, it's what we feel at our end, it is going to be a temporary downside. But on the longer run, I think this is going to benefit the company. And with all these new opportunities in sectors which are untapped, is going to open for us. So we are very confident that going forward, exports are going to do well as the domestic industry is picking up for us.
And that's going to drive a 15 to 20% volume growth, sir, you said. Would that also correspond with the top line growth that you will clock? And for how long are you seeing this kind of growth? 15 to 20%. Can we see it for the next 3 years? Is that visibility available?
So at least to be very sure that we are looking at least for 2 years, 15 to 20% growth. I think our capacities and other things are in place. And I think for FY26 and FY27, we are looking at 15 to 20% growth. And I think we will recalibrate going forward after that.
And sir, let me switch focus to margins. We've spoken about top line growth. Give us clarity here. Your margins took a knock in FY25, understandably. Why aren't we seeing a full margin recovery in FY26? Because that was just a one-off case, right? So give us the perspective on what is really happening with regard to margins. You've guided FY28, 24 to 25% margin, which is extremely strong. That's for viewer perspective. But sir, give us the perspective for FY26 and FY27.
In FY26 and FY27, I think you will be seeing a steady state of margins. I think with the kind of storm we have weathered in the past, I think right now this quarter has been transitory. So I think going forward, you will see steady improvement in terms of margins. And I think on the full year, on a standalone basis in RKFL, while we reach the last quarter of this year or the first quarter of next financial year, we should be back to our old margins. And I think that's the way we are planning it out. And you will see a steady state of margins going forward.
Okay, so sir, steady state, by steady state, you mean 20 plus? Is that something that one can expect by early next year?
Yes, on a standalone basis, you will see 20 plus margins in the next financial year.
So that's extremely strong because you'll do around
yes.
5,500 crore of top line in FY27 with a 20+% margin number.
Yes, in terms of we at a console level, we are not looking at 20%. We are looking at close to 18 to 19% in the console side. On the standalone side, we are looking at almost 20+% margins in the next financial year.
And Mr. Jalan, just one point you made, in terms of growth also, that you're anticipating strong growth from Europe over the next couple of years. What's driving this confidence? Because commentary from most players in the passenger vehicle side has been subdued, at least for this year. They're not guiding for next year. So confidence for you for Europe, is that largely being driven by the commercial vehicle space, largely to drive the growth? And has that also resulted in some of the key order wins that you had in this quarter?
Yes, Puneet, I think with the new order wins which we have had, I think with whatever is going on in North America, we have tried to work out with our customers and pull ahead all these new order wins. And we will start seeing revenue coming in, which we were expecting next financial year to start playing for us in next quarter onwards. So all these new revenues from the Europe are going to be impacting or positively impacting the balance sheet on the upside, and is going to more than compensate us for whatever we are right now facing in North America operations.
But is that largely being driven by the commercial vehicle space? Because we've seen subdued outlook coming in from the passenger vehicle side. So would that be a fair
It is,
assumption to make without quantifying any kind of numbers?
yes, it's fairly to assume that it's all coming from a commercial vehicle space in Europe.
Okay, sir, shifting focus to North America and maybe completely off topic with regard to your business, how is the North American market taking the tariffs? And what are the structures which are being put in place, at least in your sector or segment? Are these tariffs being passed on to customers? Are customers willing to take on the tariff cost on their books? How is it playing out?
So I think it is very early. I think if you really see, since April, I think it is back and forth in terms of the quantum of tariff. I think now we have a certain certainty that what tariff is going to be. So I think you will see coming in coming days and months things to stabilize. For RKFL, I think 20% of our volumes which are being exported to North America goes directly into US, which will be facing tariff. Rest of 80% either go into Canada or go into Mexico, which do not come under tariff regime. So I think so this 20% we are negotiating with the customers, and I think for us, I think it is a very clear message to our customers that they will need to pay for that. And most of the customers or most of the suppliers from different countries, I think that is way that they are working it. I mean, I think tariff, all said and done, will be paid by the US consumers. Neither the country specific is going to pay these tariffs, or nor the companies who are suppliers who are going to pay these tariffs.
Jalan, you mentioned the 20% will be impacted by tariffs. I'm guessing that is larger industry issue as well. So are you seeing any kind of consolidation in those orders in the US because of this aspect?
No, I think we have not neither lost any. Sorry, neither we have lost any orders or nor I think we are facing any types of pushback from the customer. Basically, the market in North America is down almost by 50 to 60% in terms of manufacturing. So that's the concern and that's the pushback we are having from the customer. So I think as and when they start consuming parts or as they start pulling parts, they will be paying tariffs, and that's the way ultimately the vehicle cost is going to be passed on to the consumers.
From my side, Mr. Jalan, you'd mentioned last quarter that you will be infusing capital into the business and roughly about 200 odd crores, which was the erosion from the inventory issue. Any kind of update that you can provide us in the timeline for FY26, and are you still committed to infusing capital at 2100 rupees per share?
Yes, we are committed to putting in 205 crore rupees into the company, and I think we are just waiting for NSE approval. Once we receive the stock exchange approval, 25% of the warrant money is going to come in immediately, and the balance money before March 26 is going to be funded into the company. So entire warrant money we are committed to get into the company before the end of this financial year.
What will you do with that cash balance inside the company? Will you pay off debt?
Yes, we'll utilize. We are looking at almost 300 crore rupees debt reduction in this year. So basically, this entire money is going to be utilized to pay off the debts.
And so FY27, I'm more fascinated with regard to that commentary. 1,000 crore of EBITDA is what you will do. What about amounts getting blocked in working capital? Do you see that happening as well, both FY26, FY27? What's the visibility there?
No, I think right now we are not. We have also calibrated our. Most of our working capital usually gets blocked in our exports in the North American market. And with the consumption being low over there, accordingly, we have recalibrated our dispatches to our warehouses in North America. And I think we will not have any funds blocked in terms of inventory sitting in our warehouses in North America.
Excellent, Mr. Jalan. This has been a very candid chat. Thank you for that. Also, what really stood out for me, viewers, as part of this chat, and I'm sure even for Puneet, is the fact that he was unequivocal. Mr. Jalan was unequivocal. We will not be bearing absolutely any component of the tariff imposed on us. It will be completely passed on to the US consumer. At least currently, that seems to be the verdict, that they will not bear it. And that means that they will hold on to margins pretty much on their entire top line.
Definitely. And you know, one positive outlook from this is that at least for this quarter, what the management had to do was assure the shareholders of growth and margins. And I think they've done that. I think it's just following on this aspect going forward.
Correct, absolutely. All the time we have on KYC, viewers. Thanks so much for tuning in. From Puneet, myself, and everyone who puts this show together, thank you so much. Grateful.